What's up guys, Americano back here with another video. If you haven't noticed by now, the videos this week are drastically different than normal. We've been going over strictly macro concepts that in combination with these same dynamics that we've seen coming out of the crypto market, talking about Bitcoin dominance, Ethereum price in Bitcoin, others BTC, all of these mysteries we've been trying to solve about how this does not look like a bear market, plain and simple. I feel like these videos do a great job of going deeper in showing those exact same things. We've talked about a variety of macroeconomic factors. We've talked about the credit cycle, and hopefully you guys all have a better understanding of what this is, what charts we look at, and what the implications of this is for your bags. In this one, we're going to share 3 more charts that I think could be useful. These are honorable mentions from the ones I reviewed this week, but it was kind of more of the same material, and I didn't think we needed to dive into that many charts. I did want to mention them just so you guys could have access to them and play around with them as well. So we'll go ahead and review these and let me know what you guys think. Let's get into the video. All right, guys, if you have not watched my other videos this week, please, 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 I beg you to go watch the other ones. I don't say that to just try to get more views or anything like that. All of these videos tie in together. All of these videos are equally important this week. None of them have to do with a single crypto chart. I've been kind of dropping this disclaimer on here. Every single cycle, there's people that scream bull all the way down the entire bear cycle. I am possibly setting myself up to be one of those people. I have to be okay with that. I have to be okay with, putting my reputation on the line. I have to be okay with some things sometimes, because when the data presents something that speaks otherwise, especially in something as large as the debt and credit market, I find it a little bit hard to argue against, in my opinion. This is just my opinion. This is how I'm playing the market currently. This is what I'm looking at. We've had these almost unsolvable puzzles in crypto. We've seen equities make new all-time highs. We've seen equities be strong. We've seen Ethereum priced in Bitcoin hold up. We've seen others BTC even break out. We've seen Bitcoin dominance roll over on the monthly time frame. We've talked about all these things. To kind of stop beating a dead horse, I completely wanted to separate myself from that this week. Didn't even want to talk about a crypto chart at all. All of these charts, whether Bitcoin goes to 68, whether Bitcoin goes to 60, whether Bitcoin goes to 50, all of these charts are suggesting that without entering some sort of macro bear market, without entering some sort of long 2-3 year period of subdued prices like everybody expects, like we're going to into a 4-year cycle, that there will be a rise in crypto, that there will be explosive blow off tops in equities and crypto, and that is going to kind of be the end of the market, and that's going to mark the top. I don't know how it'll happen. I don't know what the narrative will be. I don't know where price is going to reverse from at this point. But everything that we talk about in these videos this week, everything that we even show in this video, granted, these are not that they're weaker charts, but they weren't as succinct as some of the other charts. So really do make sure you go watch those videos. But no matter where that comes in, all of this is pointing to some sort of epic reversal that completely just gets people off guard. I've not seen anybody talk about these things. I haven't seen anybody look at these things. Now, it also sets me up for failure, okay? And I have to be okay with that. It sets me up to be the person who holds through the entire bear market and could have sold and bought back later. It sets me up to be the idiot buying some of the most and continuing to buy some of the most risk-on assets in anticipation of this move. And like I said, I just have to be okay with that. So please do your own research on this stuff. Please really think about what I'm saying. Really try to dive in and understand. Please make sure you check out my other videos as well. This is kind of a conclusion to this series. This is kind of a conclusion to all the videos this week. So like I said, make sure you go check out the other ones. And I hate to do the long intro, but let's go ahead and dive in. All right, guys. So like I said, this is just a kind of wrap up. These are some extra charts that we were looking at, or that I was looking at, that I thought, had some good value that I still wanted to present to you guys. So the first one is JNK. I'll see if I can pull it up here. State Street high yield bond ETF. It's similar to the HYG, the corporate bond yield that I mentioned. Very, very, very similar, but I just saw HYG to be a little bit more, not even accurate is the right word, but I just liked it a little bit better. It was a little bit cleaner. So let's go ahead and dive in. One thing, the biggest thing, and I mentioned this in other videos as well, everybody's saying we're in an April, May of 2022, March even, wherever you want to say, somewhere within that fractal. Now that we've lost the low, people are saying what's it called, or I guess we would be even further potentially. But something that I wanted to point out, my observation is we are not. And the reason we are not is because of what's happening in the credit market. Each of these tops, we saw a decline in these charts, meaning these high yield bond ETFs and things like that, these high yield bonds were getting sold off. People were de-risking. People did not want to be risk on, as opposed to when these things get bid. And again, we show these in other videos. When these things do get bid, that typically marks risk on environment. That typically marks better times in all markets. We have the Dow Jones in green, we have Bitcoin in blue. And like I said, when these things get bid, a bottom is able to come in, whichever one we look at, whether we're looking at that one or that one. But when we are able to get a bounce on these charts, it immediately has a reaction in these markets that we're talking about, in these risk on markets, okay? So very similar to HYG. Also, something you guys need to know is that credit is going to sniff this out so much further. As soon as credit starts rolling over, you are on borrowed time, my brother. Whether you're, and it always does it too. I don't want to add another vertical line here, but credit starts kind of forming a little rollover into the most explosive phase of a cycle. And that's what gets you tricked. That's what makes you turn a blind eye. That's what makes you think Bitcoin can go on forever. That's what makes you think equities can go on forever. Credit is sniffing out that irrational exuberance beforehand. And we've seen that cycle after cycle after cycle, where this thing is, by the time this thing's already started rolling over, people are screaming it's a bull market still, people are doing whatever, and it's not. It is a macro bear at that point, just for it to go and catch a bid however many months later, and that be the bottom of the cycle, or that be a good time to invest in these assets. You can see kind of each point in time we do get a little bump, but I'm more so pointing to this macro reversal in here. And if we look at our momentum indicator, if we just line these up, we can keep it super, super, super simple. If we line these up with, when we got these crosses, just remove this one. With when we got these crosses, again, when we got these crosses on momentum, you can kind of see a little bit of a cleaner version. Granted, it's not going to be exact, and I think HYG actually did a better job of showing this. You can pretty much see, capitulative aspect of the bear market. Not that that would help us now. We can also use the price action itself, seeing it roll over, to confirm these things. But just strictly using these momentum indicators, right? You can see obviously good time to be in crypto, bad time to be in crypto / boring. This is definitely bad as we were rolling over and into that, and leading into capitulation. But we are not anywhere near that. We are not anywhere near a cross on the zero line on junk or on JNK or on HYG. Even when we look at price action on a closer level, again, this is the monthly time frame, but really, really nice candle close in here, dropping down to the weekly as well. You can see that we're actually working on momentum crossing to the upside. So these high yield instruments, these high yield, higher risk credit instruments do not get bid up when liquidity is shrinking, when the macro is looking bad. These are things that get sold off before the macro looks bad. So how this is going to work is this is likely going to pump. Equities likely explode. This thing kind of starts to roll over. Equities and crypto do their thing. They explode. People go and chase those, right? And by the time we've got into some sort of actual pullback in here, this chart's then rolled over, giving us a very clear sign of, hey, that's likely it. That's likely the top of the market. And then people go in here and scream bull market, and they scream bull market all the way down until this is able to find a bottom. All right, we've seen it cycle after cycle. Every single chart we've looked at this week has shown the exact same thing, very, very clearly, in my opinion, as well. But JNK is just another one of those that I wanted to present to you guys. All right, everybody, the next one is going to be US High Yield Index Option Adjusted Spread. Again, very similar kind of chart. The higher yield instruments Again, very, very similar thing. I actually marked these changes on the cross over the zero line on rate of change, right? So acceleration up or acceleration down. This chart is inverted because I thought it displayed a little bit better when inverted. We can see when this chart crosses the zero line to the upside, it's typically been bad for the market. That happens here, that happens here, that happens here, happens every single bear market. Has yet to had a cross up this time. We did have a little cross in here. I'm not sure the exact reason. I believe this was, oh, tariffs. Yep. So a little bit of a kind of relevant spike. You can see if we didn't have that, we likely would have stayed underneath this zero line, which is what we want to see in a bull market. When we look at momentum as well, we see very similar things. This thing's actually currently rolling back down on the monthly time frame, so that's really good to see. But when you see, we crossed this zero line in here, that was pretty bearish for the market. It's kind of the worst phase of the cycle. My indicator doesn't line up too well with this one, but it could have saved you from a couple capitulations in the crypto market as well as equities. Again, when this thing is starting to cross up. I have it marked on this rate of change, I think, just to keep it fresh and keep it simple. But again, showing the same exact thing, guys. Crossing over to the upside, not good for the market. When we finally cross back to the downside, I don't know why that's right there. I suppose that should be, oh, that must have, the hell did I do? Maybe I was on the weekly time frame earlier. I'm not sure why. Let me move this back. I think I was on the weekly time frame, but we can still work on the monthly as well. Because you can see, right? Good time in the market, good times in the market, good times in the market. So really good to see that. COVID in here really kind of threw a wrench. Like I said, some of these are cleaner than others. That's why these are the honorable mentions. This one has a crazy long ticker too. So some of these econ charts are kind of a pain in the ass to find. I'll go ahead and leave it up here. You guys can type it in if you want to mess with it. But anyways, another one I found really interesting, emerging market bonds. So emerging market bonds, obviously investing in emerging markets is going to be inherently more risky. You can see when these things are catching a bid, the market is doing just fine. Market is doing just fine when these things are catching a bid. It's when we actually get these rolls over that is detrimental. So people are saying it's a bear market. Again, this ties into all my other videos about Fed cuts and liquidity and credit. These are just kind of bonus charts that I'm working through here in the later half. But we still have a long way to go on charts like this, on a lot of these charts, before things actually get detrimental for the market. So people are screaming bear market this, and they're not respecting the macro at all. I don't give a shit about Bitcoin's 4-year cycle. I don't give a flying fuck about Bitcoin's 4-year cycle. Like it doesn't work on on a 4-year cycle. It works on the macro. If the macro is on a 4-year cycle, then sure, fine. But I feel like I've showed time and time again through all my videos this week that if it's timing up with the freaking credit cycle, the $1 trillion asset class, like doesn't have anything to do with the halving, doesn't have anything to do with that. So using that same logic and like we've seen in past cycles and things like that, we are just not in the same place. If we are in a January of 2022 moment, why is Bitcoin dominance in a completely different place? Why is Ethereum priced in Bitcoin in a different place? Why is others BTC in a different place? Why is every single chart related to credit in a different place? Why is the Fed about to cut rates in a different place? Fed was not cutting rates in 18. Fed was not cutting rates in 22, right? They were increasing rates. Inflation had gotten out of hand at that point. Why had inflation got out of hand at that point? Well, because they had cut rates prior. Everything's been kind of thrown off and pushed off because they were increasing rates this entire cycle, right? This is one of the main differences. They've been, screw it. I'll just go ahead and throw Fed funds rate on here because if I'm going to talk shit, I might as well throw it on there. Just give me a second. So honestly, you can pretty much see it here. Rates are flat this entire time. We do start to cut a little bit early or increase a little bit early, but Fed is increasing rates onto the back half. It's putting a crunch on credit. It's putting a crunch on all these things into what is already a bear market. Fed keeps rates low, right? Bear market starts. they increase rates into a bear market. We've started to maybe cut a smidge with what I cover in my other videos with the risk being in the labor market. I see this as getting dramatic with everything that's being priced in the credit market. I see this happening. And then when we are on the back half here, yes, we will probably see the Fed start to increase rates. People are going to scream bull market still, all these things. Emerging market bonds going to be probably below the zero line. You guys can see how this will play out. All right, we got to try to think a few steps ahead here. And like I said, these charts are just kind of a bonus video to kind of wrap up the week. So make sure you go check out my other videos. I suppose we'll go ahead and wrap it up here. I appreciate you guys as always. I'll catch you in the next one. Peace.